is there any specific criteria of a pullback to an 8-period moving average or a 20-period moving average that you can share to take the entry, like 2 or 3 candle pullback? Thanks a lot. All right. Pullback trading. Okay. Pullback trading is a very fascinating form of trading. It's actually a style of trading that I recommend for traders that are having trouble catching igniting moves. And so, guys, there are 2 types of opportunities, generally speaking. There's an igniting opportunity, an opportunity that's igniting something brand new. I was just speaking about this with a group of my traders. Something that starts a brand new move, that ignites something new. That is a very opportunistic style of market play when you're identifying and exploiting igniting events. And I believe that every trader needs a small handful of igniting events, that they understand what they are and know how to identify igniting events. Then there's the second category of opportunity, which is a pullback after an igniting event has occurred. So an igniting event might cause a 5-bar run up to the upside. Boom, 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 boom. And what ignited that 5-bar run is an igniting event. Okay. And I teach my traders what the igniting events are. All right. There's 4 main. There's 7 in total, but 4 main ones out of those 7 igniting events that typically cause multiple bar runs. And then there's the pullback events. So after this 5-bar run, being able to gauge how a stock pulls back after that 5-bar run or settles back in or rests, all right, is one of the crowning jewels of master market play, because pullbacks often lead to the secondary run in a play. And oftentimes the second run is bigger than the first run. Not all the time, but statistically speaking, the second move after an igniting move tends to be bigger and longer than the first move. Okay. And so when you're putting together an entire trading plan, your trading plan should be comprised of these 2 types of opportunities: capturing igniting events, and also being able to read how a stock pulls back after the igniting event. Now, pullback trading is easier than igniting trading. All right. So pullback trading is easier because you already have information from the first igniting move. How powerful it was, how far did it run, what type of velocity did it take to get to its top. Now the pullback. Typically speaking, if a pullback stays in the top half of the igniting run, so let's say the igniting run is $2. If the pullback stays under $1 and the pullback is mild, meaning that there's nothing violent in the pullback, there's nothing stark, there's nothing like it's ripping through past data, it's sort of drifting back. That's a healthy pullback. The drift back is a healthy pullback. Now, oftentimes that pullback toward a 20-period moving average is going to make up your best play. Sometimes it's mild enough to react off an 8-period moving average, but the pullback to the 20-period moving average is your bread and butter play. Now, what I think the question is saying is, how do you know when to act on the pullback? Well, you act on what I call a color change. So if the pullback is made up of mostly red bars, and that's what a pullback is on the downside, you're waiting for a green bar to, boom, wipe out the high of a red bar, but not so close to the peak of the initial run. You want there to be separation from the peak. So the stock has run up, it's peaked, it's pulling back. You want some separation from the peak, right? Not so close to the peak. So the color change Too close to the peak is usually a failure. You want some separation from the peak, then the color change. And that will tend to happen at or near a rising 20-period moving average if we're talking about the long side. And so you're simply looking for a color change. If that color change is happening away from the peak, and that pullback before the color change, there's nothing violent in the pullback. It's more like a hang glider drifting down versus a mountain climber falling down the mountain. Falls are not pullbacks. Violent cracks are not pullbacks. Those are collapses. There's a difference between a collapse and there's a difference between a drifting pullback. So it's the drifting pullbacks that tend to ignite the secondary run, and that secondary run will tend to be longer in duration and bigger overall from a profit perspective than run number one. And so if you become a master at capturing igniting events and also being able to read which ones offer a secondary run after a healthy pullback, you've got the whole game of trading covered. There is nothing else. All trading falls under those two categories, igniting events and pullback events. Now, if igniting events are giving you trouble, then you should adopt a pullback trading strategy for a while. All right. But the true master has them both under control.